Warren Buffett considers The Intelligent Investor the best book on investing ever written. He states that reading it at age 19 permanently shaped his perspective on money and wealth. But the book contains almost zero complex math. It offers no secret formulas to get rich overnight, and Benjamin Graham explicitly states that his work will not teach you how to predict the stock market. That quiet, grounded approach sits in sharp contrast to how most people interact with money today. We're conditioned to see the stock market as a high-stakes casino, staring at glowing screens and watching numbers tick up until everyone feels like a financial genius during a bull run. Pressing a buy button is easy, but actually being an investor requires moving beyond the speculation that drives most participants to gamble on price movements. Succeeding in the market involves mastering your own psychology rather than battling external price movements. To survive, you have to look at the exact same data everyone else sees, but filter it through an entirely different behavioral mindset. Speculators buy ticker symbols based on social media hype, or FOMO, often operating with zero knowledge of how the underlying company actually makes money. History shows the outcome of this behavior. During the dot-com bubble in 1999, people threw massive amounts of cash at companies with zero revenue and no product. They bought purely because a company had a trendy name and paid a severe price when the hype evaporated. Intelligent investors evaluate a stock purchase with the same scrutiny they would apply to buying a neighborhood pizza shop. They aren't checking the shop's theoretical resale value every 5 minutes. They check the plumbing, evaluate the profit margins, and assess if the neighborhood will still want that pizza in 10 years. Daily price fluctuations are irrelevant. This leads to Graham's golden rule. If you wouldn't feel comfortable buying the entire company outright based on its real-world business model, you have no business buying a tiny fraction of it. To test that discipline, Graham invented Mr. Market. Imagine you own a coffee shop, and every morning an emotionally unstable neighbor walks in to offer a price for your business. Some days he's ecstatic and offers you millions. Other days he's depressed and offers you pennies. A speculator takes this neighbor's mood swings literally. When the market crashes and Mr. Market screams that the economy is dead, the speculator absorbs that panic and sells their shares at the absolute bottom. Meltdowns like 2008 or 2020 are clearance sales for an investor. They use the panic to buy premium, highly profitable businesses at massive discounts. But even careful investors make mistakes. To protect yourself against flawed research or unexpected economic shifts, you need a mathematical defense mechanism, the margin of safety. This rule dictates that you never pay the full estimated value for a stock. Think of it like structural engineering. If you know a 10,000-pound truck needs to cross a bridge, you build the bridge to hold 30,000 pounds. That gap provides a mathematical cushion for error. This principle is the perfect defense against FOMO. If a great business gets too expensive and loses its margin of safety, you simply sit on your hands and wait for Mr. Market to throw another tantrum. The market exists to serve you, not to instruct you. By waiting for a discounted price, you minimize your risk of loss while maximizing your potential upside. A specific trap consistently causes smart people to lose money: the middle ground. Casually trying to pick individual stocks without doing deep research is a guaranteed way to bleed your cash. Graham forces you to pick one of two disciplines. The first is the enterprising investor, a financial detective who treats investing as a demanding, time-intensive job. They hunt for specific undervalued companies by tearing through balance sheets. The second discipline is the defensive investor. This person accepts they don't have the time or a competitive edge. They ignore financial news, buying broad index funds consistently using dollar-cost averaging, regardless of what the market is doing. Both paths are highly effective strategies for building wealth, but you must definitively commit to one. Floating between the two is how you end up reacting to trends and destroying your own portfolio. Benjamin Graham observed that emotional discipline is a more accurate predictor of success than high IQ. High intelligence is easily hijacked by primitive fear and greed. When extreme market turbulence hits, raw intellect alone won't stop a smart person from panicking and abandoning a well-researched plan. The only reliable antidote to human emotion is an automated, mechanical system. By setting strict rules for dollar-cost averaging and regular rebalancing, you operate like an airplane flying on autopilot straight through a storm. True wealth building is incredibly boring.
Treating stocks as a slow, methodical business lacks the dopamine hit of speculation, yet that very patience is your primary advantage. Master your emotions, demand a margin of safety, and definitively pick your lane. By sticking to these rules, the stock market becomes an engine designed to quietly transfer wealth from the impatient to the patient.